Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about all things financial literacy. And today we're going to be talking about a strategy that you can actually use to never pay taxes again. And this strategy is being implemented by some of the wealthiest men in the world today. And we're going to explore exactly how we can take advantage of this as just everyday investors, business owners, or just even individuals who would like to cut down our tax obligation. You may have heard of this strategy a few years ago. There was an article published by ProPublica. They obtained IRS information showing how billionaires like Jeff Bezos, Elon Musk, and Warren Buffett pay little in income tax compared to their massive wealth. And sometimes they paid nothing at all. However, anyone can actually implement this strategy. I've been using it myself to a degree, but we'll talk about that. And we'll talk about exactly how you can do the exact same thing. We're going to give an example of how it works in practice. And I'm also going to teach you how to implement this strategy. We have a lot to cover. So without further ado, let's get right into the video. The buy, borrow, die strategy is actually pretty straightforward once you understand each of the three steps. Many Americans, as most of us know, live paycheck to paycheck. You have just enough money to pay your bills, maybe a little bit to go out to keep yourself from being sad and depressed, and you have little to no money to invest or no time to even learn about this kind of stuff. In recent years, the median American household income is $70,000, and they paid around 14% in federal taxes. The highest tax rate that you can pay is 37% for a single person. And I'm going to give you an example of that. If you're a single or you're an individual and you make $609,350 or more, you're going to be paying 37% in taxes. You only have to pay this much in taxes, the previous figures, when you work a job. That's the reason why billionaires like to acquire assets. That's the reason why on this channel, a majority of what I talk about is making money from leveraging credit. And then when you get the money, you purchase assets. You always do that. Unlike working your job, assets like stocks and property, the gains are not defined by the US law as taxable income. So what I mean by that is if you've invested $50,000 and then you've doubled your money and made $100,000, that $50,000 that you've gained is not taxable by the government because it's not seen as actual income that you made unless you sell it. So simply put, if you work a 9-to-5 job, you can potentially pay 37% in taxes. If you buy assets and you don't sell them, you'll never have to pay taxes on those assets, which brings us to the first step in our wheel here. So buy, borrow, die. So let's start with buy. So the buy part is what it sounds like. You use part of your wealth or your income to purchase appreciating assets, stocks, real estate, artwork, fine wine, or other collectibles. So like, for example, if you thought that Jay-Z was buying a Basquiat because he liked art, that's not what he was doing. He's acquiring an appreciating asset. And then we're going to go over the purpose of this. So the purpose of doing this is to capitalize on the increase in value of those assets. And you're going to see those assets increase over time. The realized appreciation that you get from real estate, for example, tends to go up in value year over year. Unlike vehicles, that's why I didn't talk about that. Vehicles are not a appreciating asset, and other forms of, property. Most things that you buy for the most part aren't too much appreciating. Owning property like real estate can also be a way to hedge against inflation and rising inflation or increased volatility in the stock market. So that's the reason why when we're looking at this particular strategy, we're really looking at stocks and real estate. Those are the two things that you really want to make sure that you have. Moreover, buying real estate can lead to tax breaks if you're able to write off the depreciation. You can also generate current income if you own a rental property that you lease out seasonally or on a full-time basis. So that's the reason why we want to focus on stocks and things like dividends, because you can put your money all in a stock and you can make money from dividend yields, or you can also have real estate. It'll appreciate over time, but you can simultaneously create passive income by renting it out. All right, so step one was really easy for us to understand. Hopefully, I think everyone kind of gets, okay, I buy assets. That's easy enough to understand. Now, step two is a little more nuanced, but keep in mind that the whole point of buying assets is that you never sell them. And of course, I know you're probably thinking, well, if I buy assets and never sell them, dividend income is very small unless you have a lot of money. And in real estate, unless I'm renting it out, then I'm not going to create passive income. Well, I'm going to talk about exactly what you do when it comes to the borrow step. But remember, we want to keep in mind the whole point of this is to buy assets and never sell them. You never want to sell them because they will rise in value. And as long as we don't sell, we'll never be taxed. Okay? Keep that in mind. Once you've purchased these appreciating assets, the next step is to borrow against them. In other words, you use those assets as collateral for a loan. And I'm going to give you an example of that as well. Leveraging assets as collateral allows you to borrow money while preserving the value of the underlying asset. So rather than selling off the investment for cash and being subject to capital gains tax, you borrow against your asset instead. There is a double tax benefit here since you're not on the hook for capital gains tax and the loan proceeds are not counted as taxable income. So now we're going to move on to step 3. So no one likes talking about this, but step 3 is very important. I hear people talk about generational wealth all the time. Well, in order for you to create generational wealth, it has to go to someone else, right? Thinking about our death is not pleasant, but wealthy people understand the importance of estate. Minimizing estate tax is often a top priority, as doing so can help you leave behind more of your wealth for your loved ones or your heir or your children or the next generation. With the buy, borrow, die strategy, the individual who inherits your estate can use some of the assets you've passed on to pay off outstanding loans. Additionally, your heirs benefit from a step up in the cost basis of those assets once they receive them. And I'm going to talk about what that actually means. But the step up allows them to avoid any capital gains due to the sale of those assets that they inherit. The other option is for them to hold on to the assets and not sell them. If they decide to go that route, then they can continue this same strategy of buy, borrow, die for anyone else in the next generation. So let me give you an example. Let's say you paid $100 for Tesla stock. That price of $100 is something called basis. In the tax world, basis basically means the original price that you paid for this asset. Now, if you turn around and you sell that share for $100, you don't have any taxable gains. So you don't have to pay taxes on it because you bought it and you sold it for the exact same price. There's no appreciation there. Let's say you bought Tesla stock for $100, but it's now worth $500 and you sell it. You now have $400 of taxable gains at 24%. On the federal level, the minimum is 24%, and that's not including state. That's just on the federal level. Now, here is the benefit of dying, owning an asset, and leaving it to your heir, and why this is so much better. Instead of you selling that asset down the line when it's worth $500, if you die, it gets passed down to your heir, and then something great happens from a tax standpoint. You get to pass this asset down at fair market value from the date of death, meaning if they sell it that same day that you die, they do not have to pay taxes on that asset. So they get to start with their basis being 500 instead of 100 because of your death. They're not subject to the federal taxes or state taxes that they would have to pay. That's what a step-up basis is. And this is how wealthy families in the world have maintained wealth for generations. So you can do the same thing by passing it down to your heir, and they can lock in that new basis and get to take advantage of that appreciation. And they can also then do the same thing and pass that down to the next generation. Now, I'm going to show you how I use this strategy. This is going to be an example of using the buy, borrow, die in practice. And this is what I'm currently doing right now. So I've talked about my investments in my brokerage account and how I invest on a weekly basis. I take all the money that I make from YouTube. Everything that I get here is invested into the markets on a Tuesday. Every single Tuesday, it's invested. I'm buying stocks. All right. So just like the previous example, step 1, you want to buy assets. So I buy stock. Now, how do you borrow against your stock? Many brokers allow clients to take out a portfolio line of credit. And this is also called, other things like a SB lock loan. But I'm just going to go ahead and just use the term portfolio line of credit, but it's called many different things. So if you see it as something else in your brokerage account, just know that they're all the same thing. SB lock, portfolio line of credit. You'll see a couple of different names for it. You can borrow against the account and generally use the money for whatever you like. You can use it to pay bills. You can use it to do other investments, whatever you choose. You can do that with this line of credit, potentially even buying more securities or diversifying and maybe you putting that into something like real estate. Portfolio lines of credit give you access to your investment money without triggering the usual capital gains tax. Now, like a regular loan, you'll pay interest on whatever amount of money that you borrow, but a portfolio line of credit typically charges a variable rate that fluctuates as the prevailing interest rate moves. So you'll see the interest rate move up and down, but even if you look at the rates, like at the date of this video, they have some as low as 1.90%, some, going up to, I've seen, I think close to 7%, somewhere in that range, but it fluctuates and the rate moves up and down, and you can look at the best one. There's many different places to look. Here's the cool part. Unlike a regular loan, you won't have any sort of preset repayment schedule. What I mean by that is most loans are like, oh, in 60 months, you have to pay off this loan. You do not have a particular repayment schedule, so you can pay back the loan as you like, or you can even leave it outstanding indefinitely. Any unpaid balance will continue to accrue interest until it's paid off completely as cash comes into the account and reduces it. Interest rates have been rising. Lines of credit can still offer some of the lowest rates around, and you'll probably notice these rates are better than personal loans, mortgage rates. It's going to be pretty low in comparison to what you're seeing for any other loan, credit card interest, all of that. So this is a much better option for you. Keep in mind that the value of your investments or the underlying collateral, any asset that you have, it's going to fluctuate with the market. So in a volatile environment, it could have negative repercussions and you could end up actually owing a lot more money than you borrowed in the first place. So just understand, this is a strategy that takes you having a lot of discipline. You need to always have, in my opinion, cash flow from a business, no matter what you're doing. I believe that at least to a certain degree where your assets make enough passive income that it's going to sustain your living situation. Until then, you need to have a cash flow business. Now, for someone like a billionaire, they have no cash flow issues. They just don't want to pay taxes. So this is a great way for you to avoid paying any taxes, especially when you have plenty of cash flow. If your portfolio value declines below a certain threshold, triggering what's known as a margin call. If you've ever done any trading, then you know what a margin call is. If you use margin, I'm not talking about using margin as far as buying securities. You should already have the money and the cash to buy your securities. I'm not talking about that. But when it comes to the portfolio line of credit, there can be margin calls, usually if your portfolio drops 75%. Now, if you're a savvy investor and you're making sound judgments, it should be very difficult for your portfolio to drop 75%. This isn't crypto that you're investing in. This is assets that have been around years. And if you're taking this seriously and you're disciplined, it shouldn't be too many things you're investing in that's speculative. It should be a lot of investments that are in like blue chips, things that, don't really fluctuate too much, even in the most volatile environments. You're going to mitigate your risk. Okay. So I'm just saying that you have to have a certain level of discipline and experience in order to make this work. Now, if you do have a margin call, you may be required to deposit additional funds, aka add more collateral. So that's why if you have a cash flowing business, it's not going to be that difficult for you to just add more collateral if you needed to, or to sell a portion of your portfolio to repay the loan. That's the last thing that we want to do. But if you have cash flow, you should be able to add more to that to sustain this. Because the interest rate on a portfolio line of credit is not locked, again, meaning it fluctuates, it goes up and down, it's variable, the rates will go up and down at any time. Having a variable interest rate can come in handy in low interest rate environments, but it can hurt when the rates go up. Again, this is why I have to always express, stop trying to buy stock in real estate and use it as your cash flow business if you don't have money. That only works if you already have a bunch of money from a business or somewhere else. That doesn't work for you to try to make money with if you don't have something else to sustain. Okay. Real estate and stocks are assets. They're not cash flow businesses until you have enough assets to sustain your living. Okay. Let's just don't try to, don't skip a step. Now, if you want more information on this, I'd be happy to make a separate video about portfolio lines of credits or secured back lines of credits, SB locks. I'll be more than happy to do that for you. This is a strategy that I've implemented to a certain extent. Instead of selling, so even though all of my money or a majority of the money that I make is in a brokerage account, I always have access to it. And when I die, my heirs will receive step up in basis and they can sell the shares as they please. And if I raise them to maintain this account, they will continue to grow the wealth. But that's why it's important to teach your kids to be heirs, because if you don't teach them how to maintain this does them no good if they don't know how to maintain it. So you should be raising your children to be heirs and to take over this account. So you have to educate them on doing this if you're going to be passing it down, because if not, they're more than likely just going to sell it and they're going to spend it. And then that kind of ends it. And then someone else will have to come and start over from the beginning. Hopefully, if it starts with you, it'll continue down for generations. Now, let me sum up all the main benefits for you. You still own your shares in future appreciation because, of course, you never have to sell. So you will get to keep that. No taxes that you have to pay on the gains because the gains are unrealized. Unrealized gains means that you have not sold. You do not have to pay taxes on unrealized gains. You can use this money to diversify your investments like in real estate. What you don't want to do, in my opinion, is use this strategy to buy more stocks. You want to put it somewhere else where you can reduce your risk. The best thing that you could do is diversify, but you can then have your money working for you and appreciating on the stock side. Then you can use this to borrow against your money, and then you can go get some real estate. And now you're getting to really get the most of your value. Other benefit is you double your return. So you can make money with your stock appreciation, and then you can invest in uncorrelated things to make more of a return, of course, minus the interest rate that you have to pay. Essentially, you're using the same money to invest in multiple assets. The last benefit is the best to me. The interest that you pay on the money that you're borrowing is tax deductible. And I'm going to give you an example. Let's say that you borrow $500,000 against your assets, and you normally can borrow up to 50%. So you'd probably have to have $1 million in your portfolio in order for you to get up to 500,000 at a rate of 4%, which is fairly high. And I'm going to use rough numbers. If you got 4%, you might be paying around $2,700 a month or $32,000 a year. That's in interest. That $32,000 will be tax deductible. So in this example, $32,000 can be used as a deduction for, let's say, your real estate investment, or maybe for an investment in your business. This deduction does not count against personal expenses. So if you're using this to pay rent or things like that, then it's not going to be tax deductible. In this video, I can't cover all the scenarios, but any good CPA should understand this. They should be able to help you out with this if you talk to a CPA. And that's the reason why I believe that you should know enough yourself to tell the difference between someone who is good or who's competent and who's not competent. So with all the information that you learn from this video, if you talk to a CPA and they have no idea about any of this, you may want to go with someone else, because that may not be the person who you want to handle any of your investments or any of your taxes. So just be aware that if you need questions answered and you do have a lot of money and you have assets and you want to implement this strategy, make sure you talk to your tax professional and they can go over all of the ways that you can save. And again, if you do this properly, you're going to be able to get so much money to borrow against, and you can really diversify all of your investments and you can grow your wealth so much faster. Now, let's talk about how this works with the business. Let's say you start a business and you have to have a good amount of money being generated in order for this to work. There's some people who start a business and they put so much money into their business, they never actually invest in assets. And the problem with that is you're not diversified. If you only make money from just your business, and let's say for whatever reason your business gets halted, for some reason you can't make money, you do not want the only asset that you have to be your business. So you can borrow against your business using this same strategy. And the first thing you would do is start a business. Now, once you start a business, again, you have to figure out what that is. You have to make the cash flow. You can then get a business loan. This is why I try to get you guys to understand, get away from credit cards are good, but at some point you need to get business loans. And this is when I said, when you want to make millions of dollars, when you want to buy commercial property, hopefully this is all starting to make sense why I'm telling you credit cards are just scratching the surface. You need to do a lot more than that if you want to build wealth. Let's say you worked your butt off. You have a business that makes $4 $3 million a year. And again, you only have your business because you've invested all your time into it. That is a bad situation, and we need to make sure that we have some liquidity freed up for other investments. You can take a business loan against your business, and you can use that to buy assets with your business, like stocks and real estate. So this is a great way to free up your liquidity, and you can buy assets, and then you can still borrow against those same assets as well. This is why I want you guys to understand that debt is not a bad thing if it's being utilized properly. Debt is only a bad thing when you're trying to borrow other people's money and you have no money yourself to pay back what you're borrowing. That is when you get in trouble. You need to go out there, figure out how to get the cash flow on your own. And once you do that, this type of strategy will become available to you. Again, you're not going to get the business loan without having tax documentation, things like that, which means you have to go out and actually make the money. But once you make the money, look at all the benefits that you can do to avoid paying taxes, either very little tax or no tax at all. I honestly believe that you cannot build significant wealth in most cases. That's not an absolute, but in most cases, you can't build significant wealth without using good debt. But before any of this is possible, again, you have to generate cash flow. You need to start a business that can do so. And this is another strategy that you can implement, or you can also do investments into either real estate or stocks, and you can do the same thing. But then you can buy your assets, borrow against it. You're never going to pay any taxes on that because you're not going to sell any of your appreciating assets. And then you can die on that and you can pass it on to your heirs. And this is the best way that you can avoid paying tax whatsoever. Thank you guys so much for watching this video. I really do appreciate you taking the time to listen to this. If you would like more content like this, please drop a comment below. I'd be more than happy to go into more depth, give better examples, and really go into great detail about this and breaking this down bit by bit. I want you to understand that cash is really completely worthless. Cash is worthless. I want you to understand that just using other people's money and borrowing it will not make you successful. You have to go out there and do something that actually generates $1 from your time and your effort. But once you are able to do that, look at all the benefits that you can get. All you have to do is get the ball rolling in the beginning. And once you work your way up, the sky's the limit. You can keep more money in your pocket. You can avoid paying taxes. You don't have to worry about living paycheck to paycheck. And you can implement these strategies to build generational wealth and hopefully teach this to your children so they don't have to go through the same things that we have to go through. And we can set them up for success. And not just that, we can set up everyone else for success in the future. This is what all the billionaires do. This is what, the Rockefellers, this is what the Walmart family does. This is what Jeff Bezos, Elon Musk, Warren Buffett, the wealthiest people. This is how they avoid paying taxes, by getting paid in these salaries with their assets and then borrowing against them and then taking that to invest in more, using whatever they need to live. But they're always invested where their assets are appreciating so fast, it's nothing for them to easily pay it off and to continue doing this over and over again. I just want you to know that there's nothing that you cannot do. All this information is free. All this information is out there. The only person holding you back from your success is you. Anyone can implement this stuff. I know it takes time. It takes diligence. That's the reason why everyone cannot do it. But if you're someone who wants it enough, you will make the effort and you will make it work no matter what. And that's exactly how I feel. Hopefully this was very exciting for you. Making this video, I was very excited to share this information. And again, I really hope that this information gets shared and it's widespread. Please, if you haven't, like and subscribe this video. Please share it with someone who you think can use this information. And again, thank you so much, and you guys have a wonderful day.